Stop thinking ASML is too expensive to buy right now. Seriously. If you are waiting for a dip to buy ASML, you are making the same mistake 90% of retail investors make, and it's costing you thousands. Here is the counterintuitive truth that Wall Street understands but won't tell you. The stocks that look expensive on price are often the cheapest on value, and ASML just proved it. 8.8 billion euros in sales, 2.8 billion euros net income, a 40 billion euro full-year forecast, and a share buyback that is literally eating the float. But there's a catch, a big one. And most people are going to miss it. Let me break down exactly what ASML reported, why the market is mispricing it, and the 3 secrets you need to know before buying. I'll be honest with you. A few years ago, I looked at a stock trading at 40 times earnings. I said, that's ridiculous. I'll wait for a crash. That stock? It went up 300% while I was waiting. I learned a painful lesson. Price and value are not the same thing. Today, I'm going to show you why ASML at 700 or 800 euros might actually be cheaper than most value stocks trading at 15 times earnings. We're going to look at the actual first quarter numbers, the 40 billion euro guidance, the dividend, the share buyback, and most importantly, the one risk that could derail everything. Stay until the end, because the 3 secrets I'm about to reveal will change how you evaluate every high multiple stock from now on. Let's start with the raw numbers, because they are honestly just stunning. ASML first quarter 2026 results. Total net sales, 8.8 billion euros. Gross margin, 53%, well above their long-term target. Net income, 2.8 billion euros. To put that in perspective, in one quarter, ASML made more profit than most semiconductor companies make in an entire year. But here is the forward guidance, and this is where it gets interesting. ASML now expects full-year 2026 total net sales between 36 billion and 40 billion euros. Gross margin between 51 and 53%. Second quarter guidance. Sales between 8.4 billion and 9 billion euros. Gross margin between 51 and 52%. The counterintuitive truth? The second quarter guidance is actually slightly lower than the first quarter. Sales down slightly. Margin down slightly. Most retail investors will see that and panic. Oh no, guidance cut, sell. But that would be a mistake, because ASML is guiding conservatively. And here's why. Here is the counterintuitive truth that changes everything. It's not about the price you pay, it's about the earnings you get. Let me explain with simple math. Most investors look at ASML trading at 30 or 35 times earnings and say, too expensive. But they forget one thing: earnings grow. ASML's net income was 2.8 billion euros in the first quarter alone. Annualize that? 11.2 billion euros. Their midpoint guidance for 2026 sales is 38 billion euros. At 52% gross margin, that's 19.8 billion euros gross profit. Subtract operating expenses. You're looking at 12 to 13 billion euros in net income. That means ASML is trading at roughly 25 times forward earnings, not 35. And here is the kicker. The 2025 dividend was 7 euros and 50 cents per share, a 17% increase from 2024. They've already paid 3 interim dividends of 1 euro and 60 cents each. The final dividend proposal is 2 euros and 70 cents per share. That's a growing dividend, from a company buying back 1.1 billion euros in shares in one quarter. The trade. When a company grows earnings at 15 to 20% annually, a 25 to 30 price-to-earnings ratio is actually cheap. It's called the PEG ratio, price to earnings to growth. ASML's PEG is around 1.5. That is reasonable for a monopoly. Now let me show you something most analysts completely ignore. The share buyback program. ASML is executing a 2026 to 2028 buyback program. In the first quarter alone, they purchased 1.1 billion euros worth of shares. Why does this matter? Because every share they buy back increases your ownership percentage. It's kind of like getting a dividend without paying taxes. The math is simple. Fewer shares outstanding leads to higher earnings per share, which leads to a higher stock price. It's really that straightforward. And the dividend? €7.50 for 2025. That's up 17% year over year. And get this, that's a payout ratio of only 30 to 35% of earnings. So there's plenty of room to grow. The counterintuitive truth? Most tech companies don't pay meaningful dividends. ASML does, and they're growing it. They've already recognized 3 interim dividends of €1.60 per share. The final €2.70 brings the total to €7.50. The trade here is simple. You're getting paid to wait. While Nvidia and other AI darlings pay zero or tiny dividends, ASML is returning cash to shareholders while growing at over 15%. But let me be honest with you. There is a risk, and if you ignore it, you deserve to lose money. The China risk. ASML sells the most advanced lithography machines in the world. China wants them. The Dutch government and US government are restricting exports. If restrictions get tighter, that's a problem. The customer concentration risk. ASML's top 3 customers, TSMC, Samsung, and Intel, account for over 60% of revenue. If one of them cuts orders, that's a problem. The cyclical risk. Semiconductors are cyclical. We're in an upcycle right now driven by AI. But cycles end. When they end, ASML's earnings could drop 20 to 30%. Here is the counterintuitive truth. Every investor knows these risks. They are already priced in. The question is, are the risks overblown? I think yes. China restrictions have been in place for years. ASML has adapted. Their 2026 guidance already accounts for limited China sales. Customer concentration, TSMC, Samsung, and Intel are all expanding capacity for AI. They need ASML's machines. No one else makes them. Cyclical risk? AI is not a cycle. It's a secular trend. Analysts expect semiconductor equipment spending to grow for the next 5 to 7 years minimum. The trade, the risk is real, but the reward is bigger. Let me leave you with the 3 secrets that connect everything we just discussed. Secret number 1, the monopoly premium. ASML is the only company in the world that makes high-NA EUV lithography machines. No one else. Not Canon, not Nikon, no one. When you have a monopoly on a critical technology for AI chips, you set the price. ASML's gross margins are 53% for a reason. Secret number 2, the fear discount. Every time there's a headline about China restrictions or a chip cycle slowdown, ASML drops 5 to 10%. Then it recovers. Then it makes new highs. The smart money buys those dips. The scared money sells them. Which one are you? Secret number 3, the dividend growth flywheel. ASML is returning capital to shareholders through buybacks and dividends. That creates a self-reinforcing cycle. Less shares leads to higher EPS, leads to higher stock price, leads to more buyback power. Most investors ignore dividends in tech. That's a mistake. So what should you actually do with this information? Step 1. Watch the April 15th investor call. CEO Christophe Fouquet and CFO Roger Dassin are hosting at 3 p.m. CET, that's 9 a.m. Eastern. Listen for their tone on China and AI demand. Step 2. Calculate your own PEG ratio. Take the PE, divide by earnings growth. If it's under 1.5, it's reasonable. If it's under 1.0, it's a bargain. Step 3. Dollar cost average. Don't buy all at once. Buy a little every month. Let the buyback work for you. The counterintuitive truth? Waiting for the perfect entry price is a loser's game. Time in the market beats timing the market, especially with a monopoly like ASML. Here is my question for you. What is one expensive stock you regret not buying because you thought the price was too high? For me, it was Nvidia at $150. Drop your answer in the comments. Let's learn from each other's mistakes. Like and subscribe if you want more myth-busting financial analysis. I'll see you in the next video.